Warren Buffett is one of the few people alive who understand the stock market to its very core. And now, with over 75 years of investing experience, he also knows some of the most common mistakes and pitfalls that investors have made over the years. And luckily for you, today we'll be covering 11 such easily avoidable mistakes that, according to Warren Buffett, almost every investor makes. And you better watch till the end, because the last two are mistakes that Buffett himself has made well into his career, showing you just how easy it is to fall for these. So without further ado, let's jump right in. Number 1. Confusing volatility with risk. You'll often hear things like, "यार आजकल market बड़ी volatile है," और "ये stock ना लेना, इसकी volatility का पता नहीं कहाँ चली जाए." When picking stocks and companies, even experienced professional sources will talk about things like beta values and tell you how a stock being volatile means it's risky. But the thing is, while volatility is a thing that exists, it is not directly related to riskiness. Some stocks might be risky and thus have a highly fluctuating value, but other times the company itself might be solid, but external factors might be affecting its stock worth, making it look like it's risky when it's not. That, according to Buffett, is something all good investors must realize if they are to make it. In his words, volatility does not measure risk, and the problem is that the people who have written and taught about risk do not know how to measure risk. Risk comes from the nature of certain kinds of businesses. Number 2. Betting on the market. I'm sure you've read some headlines that say something like, "Housing market collapse is coming," or "There's going to be a boom in the tech sector," or something along those lines if you've ever taken an interest in investing. And the general idea behind such articles is that if people can predict where the market is going to end up, they can also predict which stocks are going to go up or down. And while some people have made money by betting for or against the stock market, according to Buffett, making your stock decisions based on what's happening in the market instead of what's happening with that particular stock is 100% a mistake. As he once said when referring to his own business experience with longtime partner Charlie Munger, "You may have some trouble believing this, but Charlie and I never have an opinion about the market because it wouldn't be any good, and it might interfere with the opinions we have that are good." In fact, this idea that decision-making based on a large factor of fear instead of just researching individual stocks is a big part of Buffett's philosophy, as elaborated in the next common mistake. Number 3. Not spending enough on personal investment. Now, where spending stuff on professionals and services like the ones we mentioned is a bad thing, not spending enough on other things is also a massive mistake. And at the top of that list is investing for yourself. And it's not just money you have to invest, it's time too. Any amount of time or money you spend trying not to just make money, but to learn and hone your skills by reading and researching books, maybe taking some cheap, actually good workshops, or hell, even just getting subscriptions for a few good business magazines will help you make a difference. Number 4. Diversifying too much. One of the first things you're taught when you get into investing is that you should start diversifying the moment you're able to. And for the most part, this is considered sound, if not essential advice for success in the market. Only thing is, according to Warren Buffett, that too can be a lethal mistake for many investors. As he once said in an interview alongside Charlie Munger, "We think diversification as practice generally makes very little sense for anyone that knows what they're doing." And while he does admit that it is a good way of avoiding losses, according to him, the only people who should diversify are those who don't know how to understand business. And people who actually know how to invest must never waste their money on a dozen stocks when they can instead focus on 3 or 4. Number 5. Having too much cash around. This one is also a very common misconception. In fact, I'm sure that even non-investors heard the quote that cash is king. But the fact is that unless you're going to immediately spend the money, having your wealth in the form of cash is just about the worst thing you can do, especially in a country such as India. And Warren Buffett once again agrees, saying, "We would never have cash around just to have the cash." And that we would never think that we should have a cash position of X%. And frankly, I think these asset allocation things that tacticians in Wall Street put out, about 60 stocks and 30 cash, we think that's total nonsense. Now, before we move on to the next mistake, if you've liked the video so far and are interested in watching more videos like this, please consider liking the video and subscribing to us so we can continue to provide quality financial content to viewers like you. With that, let's move on to the next common error, which is number 6, giving up on businesses because of the market. Sometimes when you find a good stock to invest in, you face some external difficulties. Maybe the currency faces a crash or petrol prices hike. In fact, any manner of external market factors might tell you that it's not a good time to invest. Well, according to Warren Buffett, if you give up on an excellent business just because the market as a whole is facing some difficulty, you might be making one of the costliest mistakes of your life. He says, if you're right about a business, if we think a business is attractive, it would be very foolish of us to not take action on that because we thought something about what the market was going to do or anything of that sort. In fact, involving unnecessary factors in your decision making is always a bad idea, as evidenced by the next big mistake. Number 7. The IQ fallacy. If you've ever watched a movie or a show that featured a very successful investor, you'll probably have the notion in your head कि सारे investors 150 plus IQ geniuses होते हैं. But the thing is, all of that is basically made up by Hollywood. In fact, even if you're very clever in most things, it's better not to apply that cleverness to investing and instead use basic logic. Because the thing is, the market isn't physics or mathematics, even if it looks that way. The market does not have any consistent laws, theories, or principles for you to figure out and exploit. So if you try to outsmart the market, you'll almost always fail in no time. But that doesn't necessarily mean you don't need other kinds of intelligence either, since one of the most common and easy to fall for mistakes that any young investor almost always makes is number 8, falling to marketing. Investing, just like any other money-making field, is an industry, and because of that, there are people who want to make money off the people involved in the said industry. And by far the best way to sell anything to anyone is to convince them that if they don't buy the thing, they'll miss out on something good. Or worse, to convince them that something awful is going to happen to their business and the only thing that can save them is the product being sold. And just like in every other field that faces this problem, most of this convincing is pretty much bogus. But because investing is already so confusing and there are so many opinions and scary ideas going around, investors are more likely to fall for these scams. And the thing is, they might not even be scams. They might be useful, but simply not useful enough to justify the cost. So whenever someone or something comes at your door, or in your case, your inbox, take a long, hard look at it and try to figure out if it's really worth buying. And in 99 times out of 100, the answer will be no. As Warren Buffett once said, the people that have the problem are the people who want to sell the services to them and are going to have to convince them that they have a problem. Number 9. Giving too much importance to the crowd. Moving on, this one should be pretty obvious. But the thing is, even if you try not to follow the crowd just by avoiding popular things, you're still making your decisions based on what everyone else is doing. When in reality, whether everyone agrees with you or whether you disagree with everyone should not have any weightage on your decision making. To quote Buffett, you need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd nor against the crowd. Because this is not a business where you take polls. It's a business where you think. Number 10. Growth confusion. Now I'm willing to bet that almost everyone who's watching this video knows about or has at least heard of growth and value investing. And while the two distinguishments are useful in some cases, according to Warren Buffett, to categorize stocks as either growth or value is plain dumb. I've often said the growth and value, they're indistinguishable. They're part of the same equation. Or really, growth is part of the value equation. In fact, he even goes as far as to say that neither value nor growth investing is useful unless they go together, saying that growth investment is useless unless the growth actually allows you to take out profits in a good amount of time, and that value investing is also useless unless there's some show of growth. In fact, he even made the earlier mistake himself. In 1989, encouraged by the ongoing growth in the airline business, Buffett bought stocks in US Air. However, even though the industry and stock continued to grow, the growth was so slow and so inconsistent that it took Buffett years to even get out of that bad investment, let alone make any real profit off it. Later on, he would say of the incident, investors have poured money into a bottomless pit, attracted by growth when they should have been repelled by it. Number 11. Waiting for price correction. And finally, we have the last of Buffett's mistakes. You see, I'm sure you've seen tips that encourage you to wait for a stock's price to reach a certain low before you put any money into it. And well, the same happened with Warren Buffett and Walmart. You see, during the early 2000s, seeing Walmart's massive success, Buffett and his company decided to acquire a big share in the company for the then price of $23 a share. However, by the time they finalized their plan, the stock price had risen into the 30s. And instead of buying at that slightly higher price, Buffett decided to wait for the stock price to drop near 23 before buying, in a mistake he called thumb-sucking. As you can guess, the stock price never dropped. And by the time he realized his mistake, Buffett had to pay nearly $55 a share instead of the $30 he would have had to pay otherwise, costing his company in the north of $10 billion in potential profits. And that's really the main lesson here. If you find a good stock that's just a little above the ideal price, don't hesitate. Because while some stocks might need a low price, if it's a good one, it'll still be a good investment at 200 rupees as much as it was at 180 rupees. And well, that covers our list of Warren Buffett's own exploits and the things that he has seen others do. What do you guys think? Which mistake stood out to you? In fact, let us know in the comments below what you think is more potentially risky, an investment in a volatile company or an investment in a business that has been growing for decades. Let us know down below. And if you found today's video helpful, you may also find our video on the book that made Warren Buffett who he is quite useful. So if you're interested, click on the thumbnail on your screen here. And well, on that note, we must end today's video. I hope you enjoyed watching it, and if you did, be sure to leave a like and subscribe for more. With that, take care, and I'll see you guys next time.